learning outcomes. After completing this video, you'll be able to explain what framing bias means, list some common investment mistakes linked to framing bias, understand the various ways in which pitfalls of framing bias can be avoided.
Framing bias. Framing bias is like saying you have a pizza, and let's say I say that I should cut the pizza into 4 pieces because I'm not hungry enough to eat 6. Framing bias is the tendency of investors to respond to various situations differently based on the context in which a choice is presented or framed. Every day there is a lot of evidence that you find of framing bias, and it can be found everywhere, even in a grocery store, for instance. A lot of grocery stores will price items in multiples: 2 for $2, 3 for $7. Now, this doesn't necessarily imply, however, that you're getting any kind of bulk discount, or none of that is being offered. Have you ever found an item priced at 3 for $7 also available at unit price of $2.33? That's not unusual. So basically, shopping represents a very rudimentary rational choice problem. So as a shopper, you probably ask, how many oranges should I buy? And good salespeople try to frame a solution to the problem that you have, problem for buyers, and they try to frame a solution that benefits the store. So the solution is framed in such a way that don't buy oranges in units of 1. That basically, it says, so implicitly the solution will be framed like buy them in multiples of 3. Now that takes advantage of people's susceptibility to framing. Framing bias can also encompass a subcategorical phenomenon known as narrow framing, which occurs when investors focus too restrictively on just one or two aspects of a situation, that in exclusion of other critical aspects, and therefore compromises their decision makings. It doesn't have to be narrow framing, doesn't have to be in investments, it can be in day-to-day life. For instance, again, take the example of shopping. Say, for instance, you are wanting to buy a lawnmower. Okay, so let's say a consumer. I'm a consumer who's and I work with a very narrow frame of reference, and I just shop for a mower that is fast, while I may overlook other features like, for instance, the blade width, the fuel economy, and there may be other factors that that might affect the length of time that is required to mow a lawn. So to consider an example from investments, framing example, that is, suppose that Mrs. Smith chooses to invest in either portfolio A or portfolio B. Further, suppose that portfolios A and B are identical in every respect, pretty much identical. Now, Mrs. Smith learns that portfolio A will offer her a 70% chance of attaining her financial goals, whereas portfolio B offers Mrs. Smith a 30% chance of not attaining her financial goals. So just framed it differently. So if Mrs. Smith is like most people, she will choose portfolio A because its performance prospects were more attractively framed. Another key point to keep in mind is that framing bias and loss aversion bias can, and more often than not, do work together. When people have suffered losses, they may view losses as the right time to embark on risk-taking behavior. When people have gained, they may feel threatened by options that entails taking additional risk. For example, an investor who's just suffered a net loss is likely to seek risk with his or her investment. Someone who has gained, however, is more likely to opt for a more sure thing, for a less risky thing, something that is risk-free. So let's now review 4 investor mistakes that are caused by framing bias. Firstly, depending on how questions are asked, framing bias can cause investors to communicate response to questions about risk tolerance that are either unduly conservative or unduly aggressive. For example, when questions are worded in the gain framework, a risk-averse response is more likely. When questions are worded in the loss frame, risk-seeking behavior is the likely response. Secondly, the optimistic or pessimistic manner in which an investment or asset allocation recommendation is framed, and that can affect investors' willingness or lack of willingness to invest. Optimistically worded questions are more likely to garner affirmative responses, and optimistically worded answer choices are more likely to be selected than pessimistically phrased alternatives. Framing contexts are often, arbitrary and also uncorrelated, and therefore, shouldn't impact investors' judgment. But in fact, they do. Thirdly, narrow framing, which is a subset of framing bias, can cause even long-term investors to get obsessed over short-term price fluctuations. It could be in a single industry or a single stock. Now, this behavior works in tandem with myopic loss aversion, which we have discussed in another video. The risk here is that by focusing only on very short-term very short-term market fluctuations, excessive trading could happen. Now, this trading behavior has proven to be less than optimal for investors. Fourthly, framing and loss aversion can both work in tandem and can work together to explain excessive risk aversion. An investor who has incurred a net loss becomes likelier to select a riskier investment, whereas a net gainer feels kind of predisposed towards less risky alternatives. So let's now discuss in which each of these specific investor errors, how you can address some of these errors, these four errors that we spoke about. First, narrow framing. Investors engage in narrow framing, investors who have narrow framing may become too preoccupied with short-term price oscillations in a particular isolated stock or a particular industry, or they may favor certain asset classes while remaining pretty oblivious to other asset classes. Investors need to keep the big picture in mind, the 30,000 feet picture in mind, which is basically overall wealth accumulation, and keeping that big picture in mind, the 30,000 feet view helps to stick to long-term investment goals. Investors should work on building balanced asset allocations and focus on ensuring that allocations are helping them meet those investment goals. Secondly, framing and loss aversion. Investors who feel that they have been faring poorly will seek out risks, while those who are pleased with the recent returns tend to play it safe. So investors should isolate from other ongoing decision making any references to gains or loss that have been incurred in recent prior periods. As always, I can't overemphasize education, can't overemphasize diversification, can't overemphasize proper portfolio management. With that, these things can help neutralize these biases. Thirdly, unintended investment choices based on incorrectly framed questions. That's not so difficult, it's an easy one. And because biases can be awakened, you can become aware when options are formulated in certain ways, and that kind of ameliorates the unintended investment choice that you do based on incorrectly framed questions. Fourthly, positive and negative frames. Positive and negative framing can exert considerable influence. Investors should kind of frame facts and choices as neutrally and uniformly as possible, even if they're given choices which are not framed that way. This reduces the likelihood of a biased response and should help you achieve your long-term investment goals.